All right, so we're going to jump right in here into module 4. So we're going to talk about fundamental analysis a bit. So when we talked about technical analysis, we said technical analysis is when we aren't concerned about what the actual firm is. We're looking at changes which are occurring in price, which is an indicator that is about to break out of a channel, for instance, and I expect to see the stock price go up or go down to some new ceiling or support. This is not that. This is more of the Warren Buffett traditional style, where you look over the financials and you try to determine where there is some waste in this company, where perhaps you could take advantage, right? And so once you have an understanding of the company itself and the fundamentals of the company, what the company actually does, then you can see, is there a good opportunity for investing here. So one of the things that we try to do is look at companies to other similar companies, right? Because we understand in our last module, we talked about the macro economic environment and then sectors and industries and how these can move together. And so the same type of thing, we have to make sure we're comparing our firm to similar firms. And so look for mispricing that occurs there. Understand there are some limitations to book value. So remember, with our book value, we buy machinery and then we depreciate it over time, that type of thing. But if I turned around and wanted to sell that in the market, the price I want to get for it is not the same as the book value, right? So we really appreciate book value because that is something we've recorded. We've got very clear rules called GAAP on how we record those things. But that is an issue because that is not the market value. And when we're going into the market, that's what's going to value more. Okay. And so the couple of different things we're going to talk about here, the liquidation value, and this is sort of, if you imagine, if I sold the assets of the firm and then I paid off the debt, right? This would give an idea of this residual value of shareholder earnings, right? As we talked about, assets on one side of the balance sheet and then liabilities being, all this long-term debt, short-term debt, and then the shareholder equity. So, that shareholder equity is basically, we know that the firm's worth at least that, right? There's also the issue of replacement cost. So if I wanted to go out and buy this company, like as a new company, I wanted to go buy these machines and all of that, then this would be what we call the Tobin's Q, which is what is the market value of the firm versus the replacement cost if you were trying to create this on your own. And then here's our holding period return, which we've talked about that before in the context of bonds, but any holding period would have a holding period return. And in the case of stocks, this holding period return is going to be the dividends that we're receiving, as well as the changes in price, right? And then that's all, what is that relative to the price that we initially paid? That would be the return that we would have. So the required return in the CAPM model, we've already discussed. So it's based on the beta of the stock, or what the stock's riskiness is relative to the market. Multiply that by the market risk premium and add the risk-free rate, right? So we would expect to, over time, go towards this K, although we've talked about the difference in convergence and non-convergence in markets. But this is how we would normally talk about our equity, that it would have some sort of required return. Okay. So the intrinsic value of the stock is what we feel that this is actually worth, right? And normally what we come up with for the intrinsic value is the present value of all of these future cash flows based on all the projects that the company's engaged in, right? So if I say, hey, the intrinsic value is higher than what it's selling for in the market. I think it's worth 100 and it's selling for 80. I should go buy. And if I say the intrinsic value is only 80 and it's selling for 100, I should sell. Right? It doesn't make it a bad company. It's just overpriced. So I should sell it and take my profit before it converges back to the real price. Right. And if they're the same, then we would say hold. Now, of course, there's always some gray area. Should I have discounted at 4.2 or 4.25? You know, those kinds of things. So you got to be really careful saying they're exactly equal. But this is part of the nuance to it. We've covered dividend discount models in previous courses, but just to go over that, with that, we say that the value of the stock is just the present value of all the future dividends, right? So we're not worried about what the stock may change to. We would say that the stock right now should be the present value of all future cash flows. Now, this dividend, it's a certain dividend at each time, but it's not required to be the exact same number. And in fact, we normally talk about dividends having a constant growth rate, right? And so it's going to grow at a rate G, right? And so what this ends up falling down to is, instead of discounting just at K, it's K minus the G, because the dividends themselves are growing to make up for that discounting that occurs. Obviously, G cannot be bigger than K. If we're growing faster than our required return, then this model would blow up. Right. And they can't be equal, because then you're dividing by 0. And this is just an example. If we have to get 14%, dividend's going to grow at 8%, and currently it's at $3. That means that D0 is at $3. So D1 would be 3 times the 1 plus 0.08, right? Which gives us the $3.24. Discount that back at the 14% minus the 8%, K minus G, right? And that tells us that it should be worth $54. Okay. And so here's the relationships that you should know. As dividends go up, the value of the stock should go up. As K drops, the discount rate itself drops. That would indicate that it's becoming perceived as being safer or something like that. So the required return is less. Then the value of the stock goes up. And then if G is higher, obviously that also helps. So all of those will change the stock price in that way. This is a different version of doing that. So instead of saying I'm going to hold this indefinitely, right, I'm going to have this string of dividends, I'm going to have dividends over some period, and then I'm going to have this capital gain, right, from the change in price. So there's a dividend yield based on the current price, and then there's this capital gains yield also based on the current price. And then the present value of growth opportunities. This is how you view a firm as like a number of real options, right? So as a pizzeria, I may decide to start selling calzones, right? And then there is some advantage to that, right? Or what have you. So there's all these opportunities for growth based on the assets that I already have. And so based on that, I could calculate what is the present value of all of these opportunities, and then add that in as part of my current price, right? Because you're buying my company based on this potential growth that I have going forward. We talked about firm life cycles, how they have the startup phase and then consolidation, then it matures, and then we have this sort of declining, there at the end. So early on, it's very easy oftentimes to find growth opportunities because you are so new. There's so many ways to grow. And then as you get larger and larger, there's more and more competition, there's fewer and fewer opportunities, and that's when the industry is very mature. Okay, and so this is another way of using sort of the price to earnings ratio, the PE ratio, and you can think of this as like a set of these real options that you have as a firm. right? And so you notice that if there are no opportunities, right, then it just looks like a perpetuity. So we just take whatever our payment is and then divide it by the discount rate. And then as these opportunities become more and more important, it grows faster and faster, right? And you notice that PE ratio would then begin to dramatically increase, right? And so when you think about growth firms, normally they'll have these just obscenely high PE ratios, and that's why, because there is so much opportunity for growth, but we don't know exactly how they're going to grow yet. This is another way of talking about this price to earnings, right? And the growth opportunities. So we pay some percentage of our net income out as dividends, and then the rest we keep, right? That's the retained earnings portion. And so the amount that we are paying out, right? We're paying out this B, right? Or we're paying out the dividend. So B is what's less. And so as this number here, right, as this number goes up, right, this whole ratio goes up, right? And then as this part down here goes down, right, then that will cause this to also increase. Right, because you're dividing by a smaller and smaller number. So over time, this is another one that they say we would expect some sort of convergence, right? So the PE ratio is where you expect them to be growing, right? If the PE ratio is above what you expect them to be growing at, then you would say it's probably overpriced. If it's less than, then it's probably a bargain in the market that you could take advantage of. Right. And then again, we have our measures, right? K is our required return in the market. G is the growth rate of, our dividends. And then this 1 minus B is the retained earnings, how much we're bringing back into our firm, or how much we're retaining within our firm to continue to grow. Right. Now, understand that we're talking about price to earnings and earnings themselves. We can try to manage those earnings. We have a lot of ways to try to keep things very steady. So understand that it's not going to be perfect, and so that's why you have to be very careful, coming up with a rule and say, I'm always going to do it this way. This is the cyclically adjusted PE ratio, the CAPE model. That's what it stands for, cyclically adjusted. So you're adjusting for the business cycle. And I have a couple of other rules that we have based on other ratios. But yeah, this is the CAPE. And then price to book, price to cash flow, price to sales. They all have their own advantages. But they also have disadvantages, because all of these in this fundamental analysis is based on using the value that exists within the corporation, or the data that exists within the corporation, right, to try to determine its value. But there's a lot of very particular rules around that. So we need to always keep that in mind. Okay, another thing we could do is look at the free cash flows to the firm, right? And so if you notice here, we have the calculation on how exactly we get that. The free cash flows are important, because this is the amount of money that the corporation has that's not already tied up into something else that we can then redeploy to get the results that we are looking for. And here's the, you see the weighted average cost of capital come up before, but basically this is a way of thinking of the value of the firm. And instead of it being the present value of like the dividends, it's the present value of those future cash flows, or the free cash flows in the future. Okay. Instead of the free cash flows to the firm, you can also just look at the piece that's going to equity holders, right? Because you may say, well, the bond holders we're not as worried about because the bond holders have already, received that their piece through the interest, right? And so I'm really focused with the cash flow to the equity holders, because those are the ones I have to keep satisfied. And so very similar in how we calculate this, only we're using just the equity piece instead of total free cash flows. Right. Now we know that all of these have some issues with them, right? That they need improvements or certain areas where some will work better than others. A lot of this is taken from things that we're estimating, right? And so again, these are some of the issues that we have when we're doing this, is that we're not in a perfect world, and so you have to sometimes compare these models and come up with what you think is a best guess. Okay. And remember that the financial analysis piece is again based on the financial statements, right? And so this is going to be your income statement, the balance sheet, and then the cash flows. And so by using these, you have a very good vision, not just of a snapshot in time, like you have with the balance sheet, but also over a period of time, like the income statement, to see how the cash flows have changed. Keep in mind that in economics, when we're talking about things like profit, we're saying, we're counting like opportunity costs and things like that, where in accounting, profit is strictly, revenue minus expenses. And so there's a difference in what we talk about in economics and what we talk about in accounting. And then in finance, we deal with both. So we have to talk about both meaningfully. As far as what we're doing as finance people, the two big things are the investment decisions, how we're deploying the capital, and then the financing decisions, how we're sourcing capital, right? So do we source it from bondholders and fixed interest? Do we source it from equity holders and this higher required return? How are tax shields and things like that playing into it? And then the investment decisions, do I spend more capital buying better machines and having higher fixed costs? Do I focus more on our variable costs and deploy the capital in other ways? That's what I'm doing with these types of decisions. And so when I'm looking at, are they doing a good job? This is what I'm measuring them against, right? And one of these could be doing well and the other one not as well. Okay, some different profitability measures, and you may have seen these, return on assets, return on capital, return on equity. Anytime you see that, the return is going to be, some sort of return. And then when it says on or over, that just tells you what's going to be in the denominator. Right. And as a measure of profitability, you notice this ROA to ROE. You probably saw this also in the DuPont formula because that's all we do in that is decompose ROE into different components. If there is no debt, right, then return on equity is going to be the same, with the return on assets. But as we take on more and more debt, and this debt to equity goes from 0, to something much higher, then ROE can be much larger. And that's why we refer to that as financial leverage, because it has this multiplier effect for the return on your shareholders to be higher. Economic value add, since we say economic value, right, as opposed to financial value, you know, it's taking into consideration some of the other opportunities that we would have had, right? And so the big takeaway is if my return is greater than what's required, then I'm adding value, right? If it's equal to K, then I'm exactly meeting the expectations. And if my ROA is greater than the required return K, then I know I'm continuing to add value. My firm is growing and becoming stronger. Here's like the DuPont. And really all we're trying to do is just decompose ROE. So what we had before was sort of, you know, just starting with, I think and early on, like in the finance, intro finance course, fundamentals of finance, we probably just had net income over sales, and then sales to assets, right? So this right here is just decomposing it a bit further, right? Just for us to be able to incorporate the piece for interest as well as the piece for our taxes. But yeah, so these last factors are the ones that we normally think about within DuPont. You know, are they really good at generating sales? Are they really good at converting those sales into cash? Or are they really good at just taking advantage of maybe interest rates, you know, and that's where this leverage ratio comes in. Right. And so as you can see, these relationships that exist, this is what we're testing for as we look at it. So I'm gonna show a few more slides. Again, feel free to pause as we go through these. But these are just some of the different ratios that we have. So there's a couple of lists, you know, where all we're trying to do is compare things so that we can look at this firm compared to other firms in their same industry, right? I don't want to compare a pizzeria, even if it's a very large one. I don't want to compare that to a grocery store, right? Because those are going to be very different. So, but when I'm comparing with similar firms, though, these are the types of things that I would look at to see where there perhaps is some opportunities. And then price to book and price to earnings or market to book, price to earnings. These are things that we look at as well to see if there's like a mispricing on the market side, right? Where the other ones were just within the firm, right? Now I said, obviously you want to compare to similar firms. What does that mean? A lot of times it's in the same industry, but also looking at the firm over time, you know, or inventory rates creeping up, you know, that could be an indicator of something, or they're dropping, you know, and looking year over year for these types of changes, you can notice when something sort of unusual is beginning to happen because those ratios will change. There's a lot of other issues we got to think about. So even if I am looking at the same type of firms in the same industry, even things like if we do last in, first out versus first in, first out, you're allowed to do whichever one makes the most sense for your company. But there's not a requirement that I have to do last in, first out for all of my inventory valuation. And depending on what I'm selling, there can be significant changes depending on when something was made. Right. There's also this issue when you have separate firms with operations that are overseas, because there can be different legal environments. In the United States, for the most part, we follow what's known as English common law. Most Commonwealth firms are going to be similar in that regard. So the UK, Canada, Australia, New Zealand. The French system is known as code law. So we have that in the United States, in Louisiana state courts. I believe they use it also in Quebec, but I'm not certain on that one. But they definitely use it in a lot of Caribbean islands. And so those changes change what corporations are allowed to do. There's things that they're just simply not allowed to do under the US or the British common law system that they would be allowed to do under other firms. So that's just one of the things to be cognizant of as we deal with international finance. And this is another way. So I mentioned Berkshire Hathaway, right? The Oracle of Omaha, Warren Buffett, he would go out and buy firms like Geico, where he saw it was being undervalued, saw an opportunity, and then would go and invest. This is a different technique. This is Benjamin Graham. Basically, he just looks at stocks who, basically they look like they're undervalued in the market because of how much a lot of this equipment is. And so that's a way to just go out to see where something's been undervalued and then buying based on that. So it's a different type of fundamental analysis, but it's a very much simpler approach. So that's all for module 4. Modules 3 and 4 are covered in exam 2. So be prepared to take exam 2. All right. Have a wonderful day.